So how do loans work with whole life insurance policies? Today, we'll look at an example of taking a loan from a whole life insurance policy, and we'll see what things look like if you don't pay the loan back, if you pay interest only, and if you pay it back in full. We'll look at the impact on your policy and see what it looks like when you take that loan, and then also after you make that payment. So what we'll look at is someone funding a whole life insurance policy. They are primarily interested in the cash value. Typically, we see people interested in whole life insurance because it's a safe place they can put money. They can access it anytime they'd like, specifically through that loan feature. And what happens with policy loans, here's why people do it, is your money, all of your money, keeps on compounding as if it were still in the policy. I'll go over exactly how when we look at the numbers. And then also, if we follow IRS rules and use the policy correctly, we can use it tax-free. So people are often interested in putting money into a whole life insurance policy for the cash value, and then they'll take loans out, typically for other opportunities, whether it be business, real estate, or tax-free income during retirement. Now, the big thing to do here is make sense of rates. What does that mean? It means looking at your dividend rate and then also your loan interest rate. And the dividend rate, there's something to be aware of there that's very, very important. We'll go over exactly what to look for versus what not to look for, which is often what is heavily marketed in the life insurance industry. So what we're going to look at as we progress into the different models is taking a policy loan and seeing what the policy looks like if we pay nothing back, if we pay interest only, and if we pay it back in full. All right. So what we'll look at is an illustration based on this model right here. So we have a 50-year-old male who is going to fund a policy with a total of $500,000, $125,000 per year for 4 years. Now, if that seems like a big number, you can take a zero off and make it $12,500 per year for a total of $50K, or you could add a zero and make it $1.25 million per year. As long as the policy is set up correctly, you'll see something like this. For the first year, the cash value is about 90% of what you pay in, and the break-even point is right around year 4. A way to tell if a policy is set up for as much cash value as possible is in the first year, I usually want to see somewhere between 80 and 90% of my payment available in cash value, and the break-even point should occur somewhere between 3 to 5 years. Sometimes a little bit longer if I'm older or perhaps I have some health issues, but a way to tell just by quickly eyeballing a policy are those two elements. Okay, so this is what a policy looks like if I just let it sit and grow. Before we progress into loans, what did we mention we want to look at? Rates, making sense of them. Here's how we like to make sense of rates. This illustration is with MassMutual, one of the larger life insurance companies in the world. What we're going to look at here are the net rates. MassMutual's dividend interest rate for 2025 is 6.40%. Does that mean that your money is growing by 6.40%? It does not. For example, if you said, I want this policy, or I'm going to put in $125,000 in the first year, I've got almost $112,000 in first year cash value. I don't care if the dividend's 1,000,000%. It's a loss in the first year of a little bit more than 10% because I have less money in cash value than what I paid into the policy. That's how I prefer to look at these policies whenever I'm measuring the cash value growth. Now, if I prefer dollars instead of interest rates, I'll see that I'm negative in the first year. That $13,000 and change figure is the 10% loss, 10.6% loss. The second year, it's negative 1.65%. The reason why is because you're at 111 and change, you pay 125, and then you're at 232 and change. You got less back than the 125 you paid in. To be precise, you got about $4,000 less back. So you paid in 125 and your cash value grew by about 121. It's a loss, not a good place to put money. This is the drawback, by the way, to whole life insurance. The early years are the worst years, no matter how well it's designed. if you've ever seen cash value life insurance before, a lot of times that first year cash value is a 0, or sometimes it's somewhere between 40 and 60%. It's like, no, max it out to have as much cash value as possible. It's exactly what corporations do. But looking at this correctly, watch out for this. A dividend rate compared to a loan rate. If you see a dividend rate of 6.40% and your loan interest rate with the policy is 5.67%, what goes through your head in terms of an opportunity? Positive spread. I can put my money in here and earn 6.4% and borrow at 5.7. That's a 70 basis point spread if I do nothing. We have the word no up top with my little sad face because it's not how it works. Yes, here's what I would look at. Your annual yield, or just your yearly rate of return, and compare that with whatever the loan interest rate is on your policy. If you like looking at percentages, this will tell you if the annual yield is higher or lower than the loan interest rate on your policy. Very beneficial to look at that. So if we were to go back to the illustration we just had up, you can actually see the loan interest rate toward the top in this particular example. And this is for the month of May. For June, which is when we're shooting this video, the loan rate is much less than this. I think it's 5.23% if I recall correctly. So in June, the numbers would look more favorable. But we've got to look at this so we know what the true cost to borrow is, and then compare that with our annual yield. That's how most people prefer to look at it because I can get the true net numbers. So let's look at our loan models now, shall we? Here we go. We'll start with the no loan payment scenario. So first one, no payments. What does it look like? Well, to the left, we've got the example that we just looked at, which assumes you just put money in and let it sit and grow. I always like to look at this, and the reason why, if I'm going to borrow against my policy, I can see side by side the impact that this loan has on my life insurance policy. So here, we've got the cash value growth. Remember, you are going to earn this regardless if you have a loan outstanding or not. In this example, we take a loan in policy year 5, $300K. There's the loan balance. Maybe I use this to buy a property for my business, whatever, or buy a nice fancy car. My cash value goes down to 208. Before I took the loan, it was 528. It reduced by the $300K I borrowed plus the loan interest for the next year. It's accounting for that as well. So I see it drop by about $317,000 or so. So my cash value dropped. However, I'm still receiving this from the insurance company. I'm still earning dividends and interest on the full 525. My entire asset is appreciating, but my equity was reduced to 208 when I took a loan against the policy. My death benefit dropped to $1,757,000. Before I took a loan, my death benefit was worth $2,057,000. The death benefit dropped exactly dollar for dollar by the amount that I borrowed. Now in this example, we're assuming that you never pay the interest, ever. We just let it ride. What we can look at here to make sure that things don't fall apart is the cash value column. Does this continue to go up? It does in this example. Now, anytime you see me put numbers on Excel, if you're anything like me, you would ask, show me that in the actual illustration so I know you're not making those numbers up. Here you go. So this is the illustration we just looked at here. Total loan outstanding. You can see the loan compounding because I'm not paying any of the loan interest. This column here, annual loan. In year 5, you took the $300,000. That's why it shows negative $300,000 over here. Then you see this annual loan of $17,000. Then $17,974. Are you taking these loans and actually putting them into your bank account? You're not. What's happening here is you've got the loan interest that is due. If you don't pay it, a loan is processed in your policy against the available cash value to pay that loan interest. A loan is taken to pay the loan interest. That's why we see an annual loan show up here. If you were paying it out of pocket, you would see the annual outlay column show something here. The annual outlay column, first 4 years, you're paying $125 out of pocket into the policy to build the cash value. In the 5th year, negative $300. You took $300,000 from your policy and it hit your bank account via direct deposit. The annual outlay column on an illustration is going to show you that. All right, let's go back. And here's something cool to look at. Policy results. You can also call this the spread. Cash value growth. What I'm getting from the company. Loan interest. What I'm paying to the company in interest. Policy return, AKA my net results. I'm just going to take my growth minus the interest and make sure I'm not losing money, which can happen, by the way. You might recall that the loan interest rate in this example was higher than the annual yield. So if I made this loan $480,000 or $485 in this example, I'd see a negative spread there for at least a few years. It all depends what the policy is earning and how much I borrow out. But that's the kind of stuff we like to look at too. It's not always going to be cupcakes and rainbows. There are going to be times it's going to be negative. But that demonstrates what the policy looks like with no payments. Let's look at interest only and then also repaying the loan. We'll go through interest only quickly because it's going to look very similar to what we just looked at, except you've got a loan payment column. So here, same thing on the left with the growth. On the right, paying interest only. Your loan payment is in blue, and it just so happens to match the loan interest. So every year, the interest comes due. This assumes you pay it out of pocket. So now you can see the spread to the far right, and this one is going to be more favorable than the one we just looked at, where I didn't pay the loan interest. If you'd like to have assurance that these numbers are not made up, you can look at the illustration. Year 20, cash value is $826. So what you can do here is go to the PDF illustration. Always do this regardless of who you're working with. I know it's extra steps, but it's important. Year 20, cash value, $826. Or ask your agent to lay it out side by side in a screenshot or something like that. Okay, so that's the interest payment or interest only option. Let's wrap this guy up with repaying the loan, shall we? Here we go. So I like this model because it really just shows the power of the constant compounding. So here we take that $300K loan. There's the impact on your cash value and death benefit. And then we begin to repay it at $50K per year. You can literally pay it back however you want. That's why I like to show the no payment model, because it shows never paying anything. So some years I might pay nothing, other years I might pay a lot, other years I might pay interest only. It's flexible. You're in control. The insurance company is not giving you a schedule saying you must pay it back at this certain pace or by this certain time. So $50K per year, you can see how much is going toward interest and how much is going toward principal. And then when it's paid back, year 13 in this example, there's your cash value and death benefit. You compare that with the example on the far left, everything is 100% restored to exactly what it would have been as if I never touched it in the first place. Imagine if you could earn a return on top of this. For example, if in addition to the net policy return, you also took that $300K and put it into a piece of property, and that earned a positive return when you're already earning a positive return over here. Or you put it into your business, which that's my favorite thing to do actually, because business, you can have fun with it. You're in control. Anyway, I won't go off on a tangent. But if you can earn a return on top of it, it does make things even better, because you've got an asset that continues to appreciate even when you take the money out to put it into another asset that also earns appreciation or produces a return. The only thing to look at to make sure that this is truly, truly in your best interest is that cost to borrow. Because where people get sour about this, as I would get sour as well, is if I'm told I'm going to have a positive return all the time and then I don't, for whatever reason, it just wasn't made clear to me. And I'm like, nah, this is a scam. I thought I had a positive return, but then I look at the net numbers and it was negative. So as long as it's laid out clearly, even if I have a loss, it's laid out clearly and I know how I can get out of that hole and have a positive return very, very early, that's typically where people are happy. That's when I would be happy. And the golden rule is to treat others as you want to be treated, which just means show everything and how it works. Anyway, I hope you enjoyed this video. If you did, please let me know in the comments below. If you'd like to see more videos like this one, specifically focusing on loans and the net returns, let me know. If you'd like to see any other type of videos, you can also let us know in the comments below. And if you'd like to connect with us, feel free to visit our website, ibcglobalinc.com. You can check out more videos on our channel, or you could DM me on LinkedIn. As always, I hope this helps. Thanks so much for watching.